Hello, everyone, and welcome to PACE's latest webinar on the power of value chain analysis in management accounting. It's our pleasure today to have Benjamin Kofi Quansah presenting. He's an expert in this field. Before we get started, I want to encourage all those who aren't members of PACE yet to become members. You can find out more about PACE on our website, profitability-analytics.org. Today's speaker is an accomplished finance business partner with 20 plus years of experience in financial management, strategic planning, and performance management. He has expertise in financial management, strategy execution using the balanced scorecard system, business analytics, partnering with executives to drive data-informed decision-making, and in 2017, he received the Newton Award for recognition by the U.S. National Grants Management Association for strategic thinking and leadership in the grants management field. I'd like all the attendees to remain muted during the session and with your video off, since the session is being recorded. If you have questions, please feel free to put them in the chat feature, and Benjamin will be happy to answer them at the end of this session. Having said that, Benjamin, welcome, and please share your wisdom with us.
Yeah, thank you very much, Ray, for the great introduction. I'm excited to be here. Hi, everyone. We're going to have a wonderful session today talking about a very important topic as it applies to management accounting. I'm a finance professional with over 20 years experience in finance, strategy, and then grants. And I envision a future where the finance function is a catalyst for change, providing strategic insights and creating value across the organization. And if the finance function is a catalyst for change, then I need to be a catalyst for change as well, providing strategic insights. So I took a decision to develop myself in such a way that I'm in a position to wear different hats so I can respond to different problems that arise within a company. And this led me to do other courses beyond finance, courses in strategy, grants management, and so on. So as you can see from the slide, I have different hats that I wear. But for the purpose of today's presentation, I'm wearing hat number 3, management accounting. So we're going to talk about a very important topic, value chain analysis, and its importance in management accounting. But before I do that, I'd like to share a quote with you by Ralph Kanter. So Ralph Kanter says companies need finance professionals who know how to communicate not only what a company spent, but also how it consumed that spending and where it provided value and alignment to strategy. The financial skills that are needed are those which allow us to focus on the future as well as the past, with a common thread of creating value. Now, I brought this quote to you to set the tone for the conversation that we're going to have. So are you the kind of finance professional that companies are looking for? The type who doesn't only communicate what is spent through the income statements and other reporting statements, or you go beyond just what has been spent and then communicate how that spending has been done and where it provided value and alignment to strategy. If you are the kind of finance professional that goes beyond what has been spent, you are the one we are talking to today, how we can use value chain analysis in management accounting. Next slide. So the power of value chain analysis and management accounting. And you talk of value chain, and it's a very simple approach to trying to understand the activities that we undertake in order to deliver value to our customer. Next. So very simple. It involves activities that we undertake to deliver value to the customer. So what are these activities? How best can we improve on these activities that in the end, the customer benefits? Let's not forget that the customer is looking for something. Are we able to provide to the customer what they want? Quality. Are we able to provide to the customer the price at which they want the product? We should be concerned about cost. Are we able to deliver the product to the customer at the time the customer needs it? We should be concerned about time. So each stage that we engage in a particular activity, we need to ask ourselves, how does it contribute to helping the customer get what they want? Quality, cost, and then time. The value chain analysis is one way we can do this. Next. So each activity that we have within the value chain is intended to do something, add value to the customer. Is it from raw material to processing of the raw material, storing the raw material, and then eventually delivering to the customer? It is key that we understand the intention behind value chain analysis. Ultimately, we want to add value to the product for the customer. We have the customer in mind. So we're looking at three phases of the value chain. Some authors have looked at it from the angle of upstream, where you have the product development and the firm's linkages with suppliers. So eventually you get the materials available for production. Then you move to operations, and it could be manufacturing operations where you manufacture a product, or if you're providing a service, what are the operations involved in providing that service? And then you have the downstream where you focus on the customer and delivery time and the service you're providing. And this value chain analysis was developed by Michael Porter, a guru in strategy. Next slide. So we have the value chain depicted in the image that you see on your screen. So at the bottom, you can see primary activities, those key activities, the stages, the events, or activities that we need to undertake to deliver value. So we have inbound logistics, operations, outbound marketing, and then service. But there are also activities that support us to deliver those primary activities. So we talk of procurement, technology development, human resource, and then firm infrastructure. So I just want to lay the foundation for us. Then we'll look at a case study, how we can apply value chain analysis in management accounting. Next slide. So what are the key components of a value chain? So we're looking at inbound logistics. Please click. So we're looking at, it's important that I explain this. I know you may have knowledge about it already, but for the purposes of the case study that we're going to look at, we have inbound logistics, where the organization receives and then stores the raw materials needed for production. So now we have the raw materials available. What processes do we need to go through to be able to transform the inputs, the raw materials, into the final product? And after the final product has been produced, What activities are required to get a finished product to the customer? That is the outbound logistics. And then we have those support activities like marketing and sales. What strategies are in place to promote and sell the product? And are we providing after sales service after we've sold the product to the customer? These are the components of a value chain. And in management accounting, there are various benefits. And like I said, we use a case study to explain those benefits we can enjoy in value chain analysis regarding its application in management accounting. Next slide. Right. So these are some of the benefits. We're able, through value chain analysis, we're able to identify various cost drivers across processes. What is driving our costs? And what activities are there for which those costs are needed? Next. We're able to, enhance our strategic and tactical decision-making processes. That is what value chain analysis can help us do in management accounting. You see the demonstration of that very soon. Next. And then we're able to link our financial results to operational activity. So when you are provided with the financial statements, especially the income statement, can we go behind the scene and provide insights? The income statement by itself will not be able to give us the kind of information we need, the kind of analysis we need to be able to help management make informed decisions, strategic decisions. Next. It aids in budgeting, pricing, investment decisions. Next. Improves resource allocation and performance measurement. And then the final one, examines the internal firm's activities to identify how value is created. So from raw material, from inception to the end, when we get to the ultimate customer, how do we create value? At what point do we say that we have a competitive advantage, be it cost advantage or differentiation advantage? At what point? When we subject the data to value chain analysis, we'll be able to determine this. Next. So enough of the theory. I want us to demonstrate practically how we can use value chain analysis in management accounting. And the company in question we are looking at is Elite Wear Limited, operating in the garment manufacturing industry and produces corporate shirts and then uniforms. And in terms of its market, it's looking at Africa-wide as a client base, and its operations. And here I'm using operations in the generic sense. It's from fabric procurement to distribution and then after sales. Now, this company is huge on quality, timely delivery, and then cost control. So this is the overview of the company. Next slide. Now, for this particular company, its primary value chain activities are inbound logistics, where they source the fabrics and then trims. Trims are part of the raw materials used in manufacturing garments. And then for operations, remember the image I showed to you, inbound logistics operations. So for their operations, they are looking at cutting, sewing, embroidery, and then packaging. So when that is completed, the goods would have to be delivered to the customer. But before it gets to the customer, they are saying that their outbound logistics are warehousing and then shipping. And then they move to marketing and sales, where they talk about advertising, exhibitions, business to business sales. And then there's a service component where they talk about customer service, alterations, and then returns. I need you to follow through with this particular company in terms of their primary value chain activities and then the support. Okay, let's move on. Now, they have procurement as a support value chain activity. They have technology development where they have this computer-aided design software and then inventory tracking. And then when it comes to HR management, tailored training incentives. And then for firm infrastructure, they're looking at finance, legal planning, and then administration. So primary activities, support activities. Next slide. They are also huge on quality, cost, and then time, like I said. So after all the analysis, in terms of quality, these were some of the findings or metrics or outcomes that we came up with. Computer-aided design tools, improving precision and customer satisfaction. And the area of cost, they introduced lean production, which reduced fabric waste by 12%. And then they introduced automation in their system, and that decreased production time by 20%. What was the result? Enhanced delivery reliability and client retention. Let's see how they did this. So this is the income statement of Elite Wear Limited, where you have the revenue, the cost of goods sold, so gross profits, you have finance people, so you understand this is not new to you. You have marketing and sales expenses, administration expenses, operating profit, taxes, and then net profit. Now, from this income statement, it's difficult to tell which activities, value chain activities, have contributed to the cost of goods sold. Which value chain activities have contributed to marketing and sales expenses, and then administrative expenses. I want to focus on 3 data points here for the purposes of my illustration. And the data points I'm looking at will be cost of goods sold, which is $1.2 million, marketing and sales expenses, which is $300,000, and then administrative expenses. Please, you can write the figures down so we don't lose sight of what we are talking about. So in total, we're looking at cost of goods sold of $1.2 million. That same cost of goods sold that we have in the income statement, we want to break it out into value chain activities made up of inbound logistics, operations, and then outbound. The company explained what inbound logistics meant for them. Fabric acquisition and then the trims, the outbound cutting, sewing, and so on. Sorry, the operations, cutting, sewing, the outbound delivering the thing to the customer. So we've broken down the total cost of goods sold of $1.2 million into inbound, operations, and then outbound. And in terms of percentages, inbound takes about 33%, operations takes about 58%, and then outbound takes 8.3%, making a total of 100%, representing our cost of goods sold. Now, what insight can we get from this simple analysis that we have done that the income statement didn't give us? From the analysis, very simple analysis, you can see that operations takes 58%, the highest, consuming most of the resources, followed by inbound logistics. So then, what do? We need to focus attention on operations. What within operations can we work on to bring the cost down? What activities in inbound logistics can we work on to bring the cost down? The income statement did not provide us with this information. We can go ahead and break each of the costs down into sub-activities. I mean, as finance people, we need to be creative and then play around with figures so we can provide more insights to help management make smart decisions. So for inbound logistics, for example, from the previous slide, you realize it was 400,000. We can decide, okay, let's break the inbound logistics down further. And for this company, the further breakdown resulted in sourcing, procurement, warehousing, quality control of materials made up of fabric, thread, buttons, and so on. And they identified these sub-activities: fabric material purchase accounting for 280,000 and so on. So the total inbound is $400,000. And in terms of percentages, you can see fabric material purchase accounting for the highest, 70%. Customs, 10%. So this then can move us to want to do something. What can we do about fabric and material purchases? We'll discuss the insights later, but this is just to help you understand that whatever income statement we have, we can go behind the scenes and then analyze the data, the figures or the numbers into value chains. Take operations, for example, from the analysis, the initial one we did, where operations accounted for 58% of the cost of goods sold. It was 700,000. But then we can still do a further breakdown. So for operations, we are looking at activities such as manufacturing, where you have the cutting, sewing, embroidery, and so on. We mentioned that. But then for sub-activity, you have labor, you have cutting, embroidery, factory utilities, repairs, quality control, packaging, insurance, safety, and then compliance. So the same 700,000, but we've been able to break it down into sub-activities that the income statement could not provide us. The income statement focused on aggregates. And once we're able to break it down into these sub-activities, we're able to strike the percentages to know which of these sub-activities are driving our costs. Labor accounting for 35%, followed by cutting, and then you have quality control and so on. So it prompts us to begin to question, what can we do to minimize labor costs, minimize material costs? Can we enlist the services of value chain partners, partners within the value chain? Can we enlist their services so that certain things that they are better at doing, we'll let them do for us, so that we'll focus on our core areas? These are some of the questions we're able to ask ourselves when we begin to do this kind of analysis. So remember, cost of sales, broken down, the cost of sales was $1.2 million, broken down into inbound logistics of 400, and then operations of 700. Let's see outbound. Next slide. So for outbound, you have 100,000. So you put all three together, you have the 1.2. So again, for outbound, we're looking at activities such as finished goods storage, order fulfillment, transportation to customers. We're able to again break this down into sub-activities, so we can actually identify specific areas needing improvement. Warehousing, local delivery transport, and that takes the highest percentage, 40%. So if it is costing us so much, can we enlist another company who is closer to the customer to do the delivery for us? What can we do? When we do this kind of analysis, we're able to ask ourselves questions and make informed decisions. Next slide. So what are the insights that can be gleaned from the analysis that we've just done? Just taking cost of sales, cost of goods. Next. So for inbound logistics, for example, remember we had fabric or material costs when we did the breakdown into sub-activity. We had fabric material cost accounting for the highest percentage. I think it was 70% or so. So can we purchase in bulk quantity so we can enjoy some discounts? If you're able to do this analysis, then you gain this insight and then you can make a smart decision. Next. For operations, for example, when we did the breakdown, labor accounted for the highest percentage. So we see that labor is the most cost-intensive area, followed by some other factors. Again, once we're able to do the breakdown, what the income statement could not provide, we're able to gain insights and then make smart decisions. Next. And then for outbound, the insight we are having here is that the company is efficient one way or the other, but there's always more room for improvement. So can we team up with other delivery companies who can do the job at a much lower cost, or maybe find easier, faster routes, delivery routes to deliver the products to the customers? When we do this analysis, we're able to provide these insights and then answer some of these questions. So for cost of sales, we did the breakdown into inbound operations and then outbound, and we're able to identify specific areas needing improvements. Next slide. Now we move to marketing and sales. And if you go back to the income statement, you'll notice that marketing and sales accounted for $300,000. But we're saying as management accountants or as finance professionals that that is not enough. What is the story behind marketing and sales? What activities are there that we can improve so we're able to deliver value to the customer? So under marketing and sales, we have the value chain activities such as market research, promotion, digital presence, customer engagement, and so on. And we've broken this down, same 300,000, into sub-activities. So what is the component for advertising, a component for sales promotion? What is the component for market research, trend analysis? What is the component for, say, brand events and then sponsorships? What's the component for, say, customer service and then customer relationship management tools? So we're able to identify the cost for each of these activities. And in terms of percentages, we know which activity is driving our cost. In this particular instance, you see advertising taking the highest percentage of 30%, sales followed by sales promotion, and then we have sales team salaries, commissions, and so on. Next slide. So with this value chain analysis that we've done for marketing and sales for Eliteware Limited, what insights can we glean? And once we get the insights, are we able to make any prediction with the insights? So for marketing and sales, we're saying that advertising and promotions dominate. That's 30%. So brand visibility is a key driver here. And some of the things we may consider doing is to have data-driven marketing strategies so we can optimize our return on investment from whatever we spend on advertising. We can improve the effectiveness of the sales team through training and any other tools that we want to use. Advertising is huge here. Next slide. And then we come to administrative expenses. So it was $200,000 in the income statement. And if we break it down into value chain, then we're looking at strategic planning, IT systems, HR, finance, compliance, and then facility management. So like I said, we can go further and further to break this down into sub-activities. So it is clear for us which activities are driving our cost. So for admin, you have the salaries, admin, HR, finance, legal, audit, compliance, and all the other costs. You strike in terms of percentage, and you see clearly that salaries account for 40% of the total administration. And that is followed by legal, audit, and then compliance, and then IT, infrastructure, and then office utilities, and then facility cost. The income statement could not provide us with this data for us to analyze, with this breakdown for us to know which component of our cost is too high and what activities are, causing our cost to go up. So in terms of the insights for administrative expenses, so you saw it from the analysis, salaries taking the top most amount, the highest amount. So we could consider investing in automation, maybe finance systems, payroll, and that could reduce our cost. It can improve reliability. These are suggestions. Once you're able to do the analysis and you come up with those activities that are driving our cost, you think outside the box to see what can be done at each stage of the value chain so we can deliver value to the customer. Enhanced staff development may support long-term efficiency across the value chain. So we want to summarize everything that we've done. So from the income statement, we said we're selecting 3 data points: the cost of sales on your extreme left, marketing and sales, and then administrative expenses. So under cost of sales, we had the inbound logistics operations and then outbound, and that was $1.2 million. And then marketing and sales, we had promotion sales and then customer engagement. So the same income statement information, but then we are breaking that information down into value chain activities. So for administrative expenses in the income statement, we have infrastructure, strategy, HR, and IT. When we break it down into value chain, so that's the value chain area, and that is 200,000, representing 11.3% of our total expenses. In this case, total expenses, the company included taxes as part of total expenses. So cost of sales, now we know, is made up of inbound operations, outbound, and that is accounting for 67.8% of our total expenses. Marketing, 16.9%, administration, 11.3%. So we have an idea as to where we can direct our effort to. Should it go to inbound? If it is inbound, which particular activity within inbound can we work on so we can deliver value to the customer? Is it operations? Which particular activity? Value chain activity under operations. Outbound is the same for marketing. Promotion, sales. So are we looking at promotion? Is sales the value chain activity that we need to work on? Is customer service engagement the value chain activity that we need to work on? So when you do the mapping, in the end, it's the same total, but then you want to generate more insights so you can make smart decisions, help management make decisions. Next slide. So we want to combine everything that we've done. Value chain cost drivers. So look at the value chain stage. Again, remember, from the income statement, we analyzed only 3 data points: cost of goods sold, sales and marketing, and then administration. And for inbound, you see the same 400,000 there, operations 700,000, outbound. So that gave us our 1.2, and then marketing has come in, administrative has come in. So in total, you have your operating cost. We can then calculate the percentages what is the percentage of our total operating cost as far as inbound logistics is concerned, operations are concerned, outbound, marketing, administration? What are the percentages? And once we have those percentages, what can we do? These are value chain activities. We need to identify the value chain activities that add value to the customer, so we'll know the specific improvements that we can make. Please, next slide. So, strategic insights prediction. So, in the area of cost efficiency, we can say, let's focus on lean production, because if you look at the calculations and the percentages, operations alone represented like 41% of our total cost. So what can we do? We may decide to introduce automation or batch production, or probably outsource. But when we did a further breakdown into the sub-activities, you realize that material cost was a big issue, 70% of inbound logistics. So by doing value chain analysis, we can improve cost efficiency. We can improve quality. And quality is embedded in both the production, operations, and then inbound. So how best can we integrate these processes so we can reduce waste and rework? We can also decide to go the e-commerce management way. Logistics can be automated, so delivery time can be reduced. We can also decide to invest in forecast-driven management, inventory management that reduces delays from stock out. The last thing we want to do is customer wanting to buy something from us and we say we've run out of stock. We're unable to provide. The customer waits and we still are unable to provide. We'll end up losing the customer. Another strategic insight that we can glean from what we've done from the value chain analysis is the profitability strategy, operations inbound. If you go back a little, you see that operations and inbound, when we put the two together, account for 64.7% of total cost. How can we unlock efficiency in these stages? So once we go through value chain analysis, we're able to get these strategic insights, cost efficiency, quality improvement, time to market, and then profitability strategy. Next slide. So the question is, what if we relied on the income statement alone? We don't do value chain analysis. Here's the problem. The income statement is cost. It doesn't tell us where we've created value, or where we've lost value. It doesn't. Next slide. So if we rely on the income statement alone without value chain analysis, we lack operational visibility. Next. Yeah, so that's what is happening here. So the income statement is only reporting broad categories. It is not linking to any process where we can identify activities where value can be created or where value has been lost. Next. So by way of example, next. Yeah, so you saw $1.2 million in cost of sales, and it might seem acceptable, but without doing the analysis, value chain analysis, how would you know that operations were accounting for 58%? That will then help us to make a decision that let's target lean manufacturing strategies. Value chain analysis will help us to do these kind of things. And I'm ending soon. So if we rely solely on the income statement, we'll have ineffective cost management. Next. Because high-level reporting will hide your cost drivers. We wouldn't know what is driving our costs. But we need to know what is driving our cost. Is it coming from material? Is it as a result of delays in production? Is it inefficient marketing? The income statement will hide these from us. Next. Next. And then poor strategic alignment. So I've said this already. The income statement doesn't reveal the activities that are contributing to competitive advantage. For example, we might underinvest in critical value adding areas like R&D when the problem is actually something else. We don't want to solve the wrong problems. We want to solve the right problems. Next. And then there's missed opportunities for profitability. So if you don't break it down, how would you know which value chain activity is impacting our profit? We wouldn't know. So we missed the opportunity to, improve on our profitability. So again, from the example, you may focus on administration when the actual problem is maybe operations, or you may focus on operations when the actual problem is inbound logistics that is draining the most of our resources. So value chain analysis would draw our attention to the specific areas, specific activities where improvement is required. We may not have insight into time, quality, delivery. The traditional financial reports like we saw in this income statement did not capture any metrics like lead time, defect rates, and so on. But when we do value chain analysis, we're able to have access to these information. So as an example, a high cost of sales may reflect poor supply reliability, which may affect delivery time. But the income statement wouldn't reveal this information. Value chain analysis is key for us as management accountants, consultants, or whatever role you are playing. Value chain analysis is key. It's not only applicable in management accounting, it's applicable in other areas. So wherever you find yourself at, you can always deploy value chain analysis to help you gain insights. So why value chain analysis complements the income statement? Please click on next. So it tells you, the income statement will tell you how much was spent, but value chain analysis will tell you where and why it was spent. The income statement would focus on financial results. Value chain analysis is all about business processes and where you can make improvements and gain competitive advantage. Shows historical performance for the income statement. What is the situation for value chain analysis? It's not just about historical information or historical performance. We are using that same historical information to provide strategic decision-making and think beyond what has happened in the past. So as I conclude, all we are saying is that value chain analysis transforms raw financials into actionable insights. If we're able to analyze the raw financial data using value chain analysis, we gain insights, and not just insights that we can act on, and smarter decisions can be made, which would then drive efficiency, quality, and then profitability. Thank you.
Well, thank you, Benjamin, for that very interesting, informative presentation. I think we all enjoyed those case studies that really showed the application of value chain analysis and its importance in management accounting. I have a couple of questions for you. What methodology was used in splitting the cost of goods sold into inbound logistics, operations, and outbound logistics?
Yeah, so the company in question used activity-based costing. It identified its significant activities, and for those activities, costs were assigned to them. So activity-based costing was used. Activity-based costing and value chain analysis are best friends. So once we deploy activity-based costing, we can then identify those activities that are driving cost, and then we can also identify the cost drivers and all that. Yeah, so activity-based costing was used.
Right, well, that's a great methodology to use, certainly. I just want to remind everyone, if they do have a question, please feel free to put them in the chat function now. But there's another question here. Is there a specific reason for breaking down the value chain activities into sub-activities?
Yeah, that's a very good question. The whole idea was to determine how those costs had been accumulated and which activities were driving those costs. Without breaking the cost down into the activities and the sub-activities, it would be difficult to know the makeup of the cost accumulation. So you could see clearly, especially for, I think, the administration, when we broke it down into sub-activities, we could identify labor costs as a big issue for us. That was a driver of our costs. So that was the reason for breaking down into sub-activities, so that we can identify the specific, tailor to the specific areas that we need to have improvements.
We have a few more questions. One is, how important is taking into consideration while analyzing the value chain the ROI? I believe we need to ensure that even if the amount of marketing, for example, is high, the value added is reasonable. So what is the ROI on these various activities, and how do we take that into consideration when analyzing whether the spend is too high or not?
Okay, I'm trying to get the question. It says what? I don't understand the question. How important is taking into consideration while analyzing value chain the ROI? I believe we need to ensure that if the amount of marketing, for example, is high, the value added is reasonable. So you see, you are relying on everything you're doing is not from a vacuum. You are relying on data for your analysis. It is evidence-based. So based on the analysis, you would be able to determine where the improvement is required. I don't know if I got the question right and if I've provided the right answer, but data is key to addressing some of these issues. Very, very key. So once you do the analysis of the data, then you can tell, okay, I can get my return on investment in this particular area or in that particular area. Without the analysis, it's going to be very, very difficult.
Okay, we have time for one last question, and it's beyond traditional manufacturing in sectors like AI startups, consulting, R&D driven firms where physical assets may be minimal or the classical three phases of the value chain aren't always present or clearly defined. Do you think the concept of value chain has evolved? How can businesses in these low asset industries best leverage value chain analysis to drive impact?
Yeah, so in this particular webinar and in this particular example, I chose to use a manufacturing, but it doesn't mean the value of value chain analysis is limited to manufacturing. We can apply it in the service sector as well. And I've operated in the non-profit sector for quite some time. I use value chain analysis in the non-profit sector, where you identify a need in the community that you want to address, and then how best can you address the need? So you need to look for a potential donor who would be able to supply you with the funds to be able to meet the need. And it goes through a whole lot of processes: pre-award, award, post-award, close out. these are value chains. So we can deploy value chain analysis in manufacturing and in service. It's not limited to manufacturing at all. So it all boils down to the kind of analysis you're able to do from the data you have on hand.
Great. I just launched the end of webinar poll. I'd ask everybody here to please take a moment to complete it. Your input is very important to us. And with that, I just want to remind everyone again that this is a sample of the great content that PACE offers to its members. Please, we also have so many more resources that can help you in your careers and in your day-to-day job. So go to profitability-analytics.org and check out our resources and become a member today. And so with that, thank you, Benjamin. It's been a very, very interesting, very informative webinar, and I appreciate you taking the time to be with us here today.
Thank you for having me.
Bye-bye. Take care, everybody.